Hello everyone, and welcome to Virginia International University's MBA 605 Auditing. Today we're going to be discussing Chapter 24, which deals with completing the audit. And so at this point we've performed all of our risk assessments. We've gone through the 3 different phases that we had talked to in earlier discussions. We've assessed risks, we've collected evidence based on that risk, we've audited management assertions as a result of having that evidence, we've evaluated that evidence, and now we're in the completing the audit phase. And so what we'll talk about with respect to completing the audit is how we design and perform audit tests related to the presentation of the financial statements and disclosure of the footnotes that are used in the financial statements. We want to talk about contingent liabilities and commitments and what they mean. We'll talk about obtaining and evaluating letters from clients' attorneys with respect to contingent liabilities. We'll talk about how to conduct a post-balance sheet review for subsequent events. We'll also talk about how to design and perform the final steps in the evidence accumulation segment of the audit, how we integrate that audit evidence gathered in order to evaluate the overall audit results, how we, after having gone through all of those steps, how we communicate effectively with the audit committee and with management regarding what we found, and then we'll talk some about our audit responsibilities when facts affecting the audit report are discovered after its issuance that may draw our opinion into some sort of question. Again, that becomes important to us because of what we discussed back in Chapter 5 with respect to legal liabilities. Often, procedures for presentation and disclosure-related objectives are integrated with the auditor's tests for transaction-related and balance-related objectives. You recall we talked about these back in Chapter 6 and the different management assertions inherent to each of these different types of transactions or balances or presentation concerns. One of the auditor's primary concerns related to presentation and disclosure-related objectives is determining whether management has disclosed all required information. Therefore, auditors consider information obtained during the first 3 phases of audit testing to determine if they are aware of facts and circumstances that should also be disclosed. And so what this table tells us, or gives us examples of, are the management assertions related to the presentation and disclosure audit objectives, and then examples of procedures or substantive tests that we may perform in order to confirm that these assertions are legitimately met. For instance, occurrence and rights. So have we disclosed events and transactions that have occurred and that pertain to the entity? So we may an example of something to confirm that assertion is that we could review debt contracts to determine that accounts receivable are pledged as collateral. If we find that that's happened, then we want to make sure that that's adequately addressed in the financial statements. So as we see here, contingent liability is defined as a potential future obligation to an outside party for an unknown amount resulting from activities that have already taken place. So 3 conditions are required for contingent liability to exist. There's a potential future payment to an outside party or the impairment of an asset that resulted from an existing condition. Or secondly, there is uncertainty about the amount of a future payment or impairment. Or thirdly, the outcome will be resolved by some future event or events. To evaluate whether the client has applied the appropriate judgment and treatment, the auditor must exercise their own professional judgment, which may sometimes be considerable. Contingency footnotes should describe the nature of the contingency to the extent it is known and the opinion of legal counsel or management as to the expected outcome. And so we have certain concerns when we're in exercising our judgment. These concerns are presented here. The auditing standards are clear that management, not the auditor, is responsible for identifying and deciding the appropriate accounting treatment for contingent liabilities. And so we see that many of these potential obligations are verified as an integral part of various segments of the audit rather than a separate activity near the end of the audit. The first step is to determine whether any contingencies exist. And again, these surface as a result of going through the different business cycles and auditing those. It is more difficult to discover unrecorded transactions or events than it is to verify recorded information. And what we might do, steps that we can take, are audit procedures in order to identify and verify are steps like inquiring of management about the possibility of unrecorded liabilities. We can review current and previous year's internal revenue reports for income tax settlements, which may help us identify tax liabilities that haven't been recorded. Or we could review the minutes of directors and stockholders meetings for indications of lawsuit or other contingencies. And these often involve very sensitive items that are not widely known throughout the company. And so these board of directors meetings gives us a lot of insight into these, and also often will tell us what management's expectations around the resolution of potential contingencies are. Other audit procedures that we might perform are to review legal invoices. And so if we're looking at the legal invoices and they reference certain litigation matters, we might want to make sure that those litigation matters are adequately addressed and identified in the financial statement. We may obtain attorney's letters regarding litigation, so we can understand, well, here's what our attorneys think the amount of exposure and the likelihood of exposure is, and then compare that to management's determination around that, and then how are both of those determinations reflected in the financial statements. We might also examine letters of credit, which will give us insight into possible contingencies that need to be recorded. So inquiry of the client's attorneys is a major procedure auditors rely on for evaluating known litigation or other claims against the client and identifying additional ones. Many CPA firms analyze legal expense for the entire year and have the client send a standard letter to every attorney the client has been involved with in the current or preceding year. And we also want to keep in mind we have external legal counsel and we have internal legal counsel, and we involve both of those in this process so that we get a clear picture, a clear understanding of the status of any potential or threatened and current outstanding litigation issues. And then, again, based on that feedback, we apply our judgment as to the presentation of those in the financial statements and the disclosure of them in the financial statement notes. We also want to keep in mind that attorneys in recent years have become reluctant to provide certain information to auditors because of their own exposure to legal liabilities for providing incorrect or confidential information. The nature of the refusals by attorneys to provide auditors with complete information about contingent liabilities falls into two categories. The attorneys refuse to respond due to lack of knowledge about matters involving contingent liabilities, or they refuse to disclose information they consider confidential. If an attorney refuses to provide the auditor with information about material existing lawsuits or unasserted claims, auditors must modify their audit report to reflect the lack of available evidence. And that's an important point to note. We must modify it to reflect the lack of available evidence. Now, that doesn't mean that the financial statements are then deemed to be, or we issue a disclaimer of opinion or a qualified opinion. We just simply must make sure that our audit report reflects that what we weren't able to look at as a result of the attorney's lack of ability or willingness to provide us with the evidence we need in order to get to a more holistic opinion. Sarbanes-Oxley Act also imposes certain rules on attorneys, and it requires those who are serving public companies to report material violations of federal securities laws committed by the company. The American Bar Association, or ABA, also amended its attorney-client confidentiality rules to permit attorneys to breach confidentiality if a client is committing a crime or a fraud. So again, these are efforts, statutory efforts, and professional association, that is the ABA, professional association efforts, in order to enhance the ethics and of professionals upon which the investing public rely. And so this timeline is just meant to show us the time period covered by subsequent events. And so when an auditor, what are the auditor's responsibilities for researching and investigating subsequent events? And we can see that from the date of the end of the balance sheet, and we'll assume the client's on a calendar year, so from 12/31/13 to the date that the audit report is issued, or 3/11/14, that is what the time frame that the auditor is responsible for reviewing subsequent events, right? But not later than the audit report, because the audit is over, the audit report has been issued, the contract, the obligations by the auditor to the client and to the public who relies on those financial statements has been met. So the auditor is not required to review for subsequent events past the date of the audit report, even if that date extends to the date that the client issues the financial statements. And so there are generally two types of subsequent events that require consideration by management and evaluation by the auditor, and that is those that have a direct effect on the financial statements and require an adjustment to them, and those that do not have a direct effect on the financial statements, but for which disclosure in the footnotes is available or is required. Auditors must distinguish between conditions that existed at the balance sheet date and those that came into being after the end of the year. If the auditor concludes that the events reflect a material weakness that existed at year end, they must give an adverse opinion on internal control over financial reporting. And these are some examples of issues that would require adjustment to the financial statements that may not have been discovered until after year end as a result of the audit. Subsequent events of this type provide evidence of conditions that did not exist at the date of the balance sheet being reported on, but are so significant they require disclosure even though they do not require account adjustment. So the issuance of bonds or equity securities after the balance sheet date would require footnote disclosure. A merger and acquisition after the balance sheet date would not be something that you would go back and restate the financial statements for, but that they would be disclosed in the footnotes to the financial statements. So two categories of audit procedures exist to understand subsequent events. The first category includes cutoff and valuation tests done as a part of the test of details of balances. The second category of tests are performed specifically to obtain information to incorporate into the current year's account balances or footnotes as tests of the completeness presentation and disclosure objectives. And so these are some examples of audit tests that are performed in order to understand and test for subsequent events. So auditors should review journals and ledgers to determine the existence and nature of significant transactions related to the current year. In the review of internal statements, auditors should emphasize changes in the business compared to results for the same period in the year under audit and changes after year end. Auditors must examine the minutes of stockholders and directors meetings subsequent to the balance sheet date for subsequent events affecting the current period financial statements. And the letter of representation written by the client's management to the auditor formally or formalizes statements made by management about different matters throughout the audit, including discussions about subsequent events. And keep in mind, this management letter, this management representation letter, is mandatory. And so with respect to dual dating, the auditor has two equally acceptable options for expanding subsequent events testing, and that is to expand all subsequent events tests to the new date, or to restrict the subsequent events review to matters related to new subsequent events. And so here we see the 5 types of final evidence accumulation. We perform our final analytical procedures. That's looking again at these financial and non-financial relationships to determine whether or not they suggest any additional areas of risk or concern that haven't been surfaced during the audit. We evaluate the going concern assumptions, which we'll talk about later. We obtain our management representation letter, which, as you recall, we said was mandatory, and it establishes management's obligation, responsibility, and liability for reporting subsequent events. We consider the supplementary information in relation to financial statements as a whole, and we read other information in the annual report for consistency and a common sense look. And so with respect to this idea of going concern assumptions, what a final assessment of the entity's going concern status is desirable after all evidence has been accumulated and proposed audit adjustments have been incorporated into the financial statements. And so we assess it as part of our initial planning, we update it based on our audit results, and then we use analytical procedures and make a final assessment. And essentially what we're saying here is that if we don't otherwise state in our opinion, the assumption is that the company is able to stay in business for the next operating cycle. If we have a concern, we have to qualify our report by indicating to the users this concern about the company's ability to stay in business over the next reporting cycle. We also talk about this management representation letter, and we say that it is required. So our auditing standards require the auditor to obtain a letter or representation documenting management's most important oral representations made during the audit. That is to impress on management its responsibility for the assertions in financial statements. The letter reminds management that of potential misstatements or omissions in the financial statements, and it documents responses from management to inquiries about various aspects of the audit. So this is a critical key component of the audit, and we get this management representation letter, and the date of that is as of the date of the audit report. And here we see the 4 categories that are included in the management representation letter, and that's responsibility for financial statement, the completeness of information, the recognition, measurement, and disclosure responsibility, and the responsibility for recording and disclosing subsequent events. So these items should be addressed in the management representation letter signed by the CEO and CFO that is sent to the auditors. And so auditing standards intentionally refrain from defining or restricting supplementary information to enable companies to individualize the information that they present to meet the needs of statement users. Auditors must clearly distinguish their audit and reporting responsibilities for the primary financial statements and for supplementary information. Usually the auditor has not performed a sufficiently detailed audit to justify an opinion on the additional information. Auditing standards require the auditor to read other information included in annual reports pertaining directly to the financial statements. And so these are the considerations that we need to take into account when we're evaluating the results of our audit. We need to make sure that sufficient and appropriate evidential matter was obtained, that the evidence supports the auditor's opinion, that the financial statement disclosures are adequate, that the audit documentation is sufficient to meet peer review requirements of an independent review. And then we have to summarize the evidence evaluation in order to establish our opinion. And so this figure just helps us to visualize the process by which we evaluate our results and reach conclusion. So we have actual audit evidence, which is by cycle, business cycle, by account, and by objective, which is supported by the audit procedures and the sample size that were selected. We evaluate the results by account and by cycle, And what we're comparing when we evaluate those results are the estimated misstatement amounts by account and our achieved audit risk by account and business cycle. When we put all of those together, because we're evaluating the overall financial statements, and our audit opinion, if you recall from reporting, was that it reports in the financial statements taken as a whole, and then based on that process, we issue our audit report with whatever type of opinion is deemed necessary as a result of the audit. And so here, the audit report is the only thing that most users see in the audit process, and the consequences of issuing an inappropriate report can be severe, as we discussed in our legal liability section. Now, generally, another report will be developed which is sent to the audit committee, which may identify areas of concern. Auditing standards require the auditor to communicate certain additional information obtained during the audit to those charged with governance. The purpose is to keep the audit committee informed about significant and relevant information for the oversight of the financial reporting process, and to provide an opportunity for the audit committee to communicate important matters to the auditor. A management letter is intended to inform client personnel of the CPA's recommendations for improving any part of the client's business. And so again, the investing public will not see this report. This report goes to the audit committee, and if there's no audit committee, which would be unusual in a publicly traded company, very unusual, it would go to the senior management, and it would communicate a lot of other details around circumstances and findings that come out of the audit. But again, this report would not be incorporated as part of the final audited financial statements or the final audit report accompanying those financial statements, and the investing public would not see this report. So when the subsequent discovery of facts occur, that is after the date the client issues the financial statements, the auditor has an obligation to make certain that users who are relying on the financial statements are informed about the misstatements. If the auditor discovers that the statements are misleading after they have been issued, the most desirable action is to request that the client issue an immediate revision of the financial statements that includes an explanation of the reasons for the revision. The subsequent discovery of facts require the recall or reissuance of financial statements arises only from business events that existed before the date of the auditor's report. Note that auditors have no responsibility to review subsequent events after the audit report date, as we discussed earlier. And so this concludes our discussion of Chapter 24 and all of the steps and responsibilities that are inherent to completing the audit. And as you can see, there's a lot involved to just completing the audit after we've performed all of the different phases that get up to that stage. So I encourage you to go back and please read the chapter and be very comfortable with it, be comfortable with the concepts, the dates, this idea of contingent liability, subsequent events, auditors' responsibilities around those, management's responsibilities around those. And if you have any questions after you've read and thought about the text some more, then please don't hesitate to email the course facilitator with any questions. Thanks very much.